All right, welcome everyone. I'm Mark Trice, financial advisor at Clear Vista Financial. For those of you that are joining us for the first time, this is our monthly market update, and we're going to go into details of what's been going on in the market, the economy, and what we expect to see up ahead. Um, if you were listening to the radio program this morning, that's on 11:20 a.m. The Bridge, Austin. We were talking about um, financial aid, student loan forgiveness, and how complex that is. And well, there's a lot of stuff there still to be unpacked. So we're going to go ahead and get started. If you have questions throughout the broadcast today, put those in the question box, which is on your control panel for the webinar. And let's jump into our agenda for today. And we're going to talk about the index's performance, talk a little bit about the economy and try to unpack some of the confusion that's going on there. We'll talk about inflation protected bonds and why they aren't performing like they should if we have high inflation. We'll take your questions and we'll get into a lot of data. So thanks for joining us. This program is being recorded and will be sent out to all our clients and participants in the coming week or so for registering for the broadcast today. So Jesse's not joining us today, and he's taking the weekend off. It is Labor Day weekend. So let's jump down. Okay, so looking at the Standard & Poor's, the S&P 500 index, since through August 31st, the index is down about 17% year to date. Now that's not from the high that we had in early January, but 17% year to date, January 1 through August 31st. Now, the S&P, what's interesting here is that the S&P closed down the month of August a negative 4.26%. And what's really interesting is if we look at some of these trends here, and I'm going to try to draw on the screen if I can. I'll just use the highlighter here. And if you look at these trends here, well, it's not gonna work for me. Sorry about that. If you look at some of these trends, where you see this downward movement in the last half of August, right up here at the top, this is the day before Chairman Powell gave his speech at Jackson Hole, where he was really getting very, as we say in the business, hawkish, meaning that he was communicating the message that interest rate hikes will continue for some time. And of course, the market did not like that. Now, there have been quite a little bit of a run up, and our clients probably saw this in their portfolios through the month of July and early August. Been quite a little bit of a run up, and we pulled back off the lows of June in the S&P 500 index, but we finished the month of August from this peak down over 8.5%. Okay, that's how much that the market had been banking on the Federal Reserve reversing its interest rate hike policy earlier than expected. I don't know why, because they kept broadcasting and all the regional Fed presidents were giving speeches saying, we're going to keep raising interest rates. We're going to get inflation under control. And, markets just thought that they would capitulate because that's what they've done every time that the market has misbehaved. They tended to, either through quantitative easing or lowering interest rates, they wanted to appease the markets. Well, not this time. Chairman Powell made it clear that they are going to fight inflation head on, and they are not going to tolerate increasing inflation. Now, in July, if you break out the expenses for food and energy, inflation was technically 0% month over month. Now, we're still at a very high annualized inflation rate of over 9%. We'll see what the data says this next week for inflation for August. But if you've been to the grocery store, you know that the cost of the food that you've been buying has been still continuing to go up. What really kept inflation level in the month of July overall was the fact that gas prices were dropping. And gas prices, if you listen to some other broadcasts, you'll know that gas prices have not been dropping because something that the administration in Washington is doing. It's been dropping because we're not driving as much. The demand has been beaten down, and so we had some charts last month where we showed that people are driving a whole lot less, and when people are buying less gasoline, guess what? The price drops. And so we think that coming into the winter months, that gas prices may creep back up again because of the demand, and as we switch over to heating oil versus other forms of energy we use in the summertime. So keep an eye on that. I would not be surprised if gas prices continue to climb. But looking at this, the S&P 500 continued down in August, the last half of August, going down about 4.26%. In the first 2 days of September, we're down just a little bit as well. But over 17%, we're not near the bottom right now. We'll talk about that in just a moment. What about the NASDAQ? NASDAQ kind of behaved the same way. Year to date, the tech-heavy NASDAQ index is still down over 24%. And actually, going through yesterday, it's down over 25%. So the NASDAQ composite index finished the month of August down minus 4.65%. And if you look at this, hey, the pattern looks very similar. We had a little run up in August, and then it fell off in the last half. Once again, this is the day that Chairman Powell gave his speech and said we're going to keep fighting inflation by rising interest rates. But from this August 16th peak up here, the NASDAQ pulled back about 10.3% through the end of the month. And so that's concerning. We're starting to see the effects of, because especially with tech companies, rising interest rates are not good for technology companies. And we'll continue to see that drag on the NASDAQ. What about the Russell 2000? Now, it wasn't nearly as bad, but it finished down the month minus 2%. The Russell 2000, which we want to see the Russell 2000 index healthy, because this indicates that it's a broad-based economy, broad-based rally, and we want to see this rise very strongly to say that the market has breadth and that the rally will continue. But the Russell 2000 index is still down over 17.5%. I think it's down about 20% from its peak back in November of last year. You see this little rundown here after Chairman Powell's speech. That's about 9.1% through the end of the month. And the last couple of days, first days, a couple of days in September, have seen similar things where it's continued on down. Long-term treasuries. Now, this is the interesting one, because treasuries are supposed to be safe, right? We're told by the preponderance of financial advisors out there following modern portfolio theory, is that if we want to reduce our risk, we just add more bonds to the portfolio. Well, that hasn't worked this year. We're seeing that the long-term treasury index that we look at is down over 24% year to date through the end of August. And it was down over 4.7% in August alone. Now that's huge. Bonds, you really have to have a 1% rise in interest rates equates to a 5% drop in a long-term treasury, 5% drop in the price. So we're seeing some pretty big moves there in interest rates, and we'll talk about that just a little bit further. Now, this is looking at the S&P for year to date. Now, I've mentioned in previous broadcasts that there's certain types of rallies that we have within a longer-term bear market, which we are still in a bear market. You can kind of see some of these here. You know, we had a little bit of a rally in early February after dropping down about 12.5% in January. We had a little 8.8% rally here in February, only to have it go down a little bit more. In February, the index dropped about 10.4%. Then we had a really strong rally in March, of about went up about 12.7%. Now this is the point here of those of you that turn on the television and watch CNBC and you see Kramer, the guy that yells all the time and tells you to buy, to sell, things like that. This is when he declared the bear market over. But of course, he did not have a crystal ball. He did not know. This is why we don't listen to pundits on television. They're usually wrong. And we can see here in April and May, the index sold off over 17%. And then we had a little rally. Had a little rally in June and July. This is the bottom down here in June and July, and it went up quite a bit. Index went up 17.5%. Still a lot of risk on the playing field here, but you see that the index has rolled over now in the month of August again. The 3,900 down here is a key support level, and on the S&P 500. This chart is through the end of the month, so I think it's really critical that we point out that this has dropped below 39, or excuse me, that 3,900 level. It's kind of hovering right around that. If it drops below that, we probably will continue to see the index to fall in September. September is traditionally the most volatile month of the year, and it also tends to be the worst performer of the year. So it's one of those things we're just going to watch it. Could it bounce here at the 3,900 level? Sure, but we don't know. So there's been essentially 5 rallies so far, which includes really 2 tiny ones, which are not a big rally. And that's normal within a longer term bear market trend. So have we found the bottom? Has the bottom been put in? We don't know. This next couple of weeks are going to be really important. The Federal Reserve meets, I believe, the 20th through the 21st of September. Well, they'll announce another interest rate hike, we suspect, and give us some indication of what their expectations are in the future. The only problem is, at the last meeting in July, they made it really clear that they're not going to give any type of forward-looking forecasts and expectations. So it really, we kind of are flying blind as far as the Fed. They usually try to make it apparent what their intentions are. They may not give us as much information this time around, but still, S&P 500 down 17% year to date. Had a few rallies here and there, which is expected. If you go back in comparison, during the 2002 bear market, we had about 6 of these rallies. In the 08-09 bear market, we had about 5. Those rallies tended to be a little bit more dramatic than what we've seen so far, but with a lot of headwinds facing us, I would not be surprised if we see another downturn a little bit further to test these lows back in June. Okay, so just keep an eye on that. We're doing things, for those of you that are clients, we're doing things, and you know what we do. We try to protect the portfolio as best we can. If you're not a client, you may want to give us a call. We can talk about potentially what we might be able to do for you. All right, let's move on to talk about some economic updates and things. We're gonna look at several macroeconomic indicators here to kind of get a good picture of what's going on. We're going to talk about the recent jobs reports, the 10-year Treasury rates, consumer price index, which measures inflation. Once again, remember, folks, you can put questions in the box, in the question box. Be happy to try to address those. If not, we will make sure we contact you next week to answer your question. So let's jump right in. Okay, so this is a 50-year or so chart of the 10-year Treasury rate. Now, why do we talk about the 10-year Treasury rate? Well, it's indicative of what it costs consumers to borrow. A lot of times, the 10-year Treasury is used to peg what your interest rate is on a mortgage or an auto loan, maybe credit cards as well. And so it's real important. And the one thing that you notice, going all the way back to 2000, or actually 1980s, you see this long-term downward trend of a trend here. And if I could draw a little bit more, I would, but I don't want to mess up the the presentation, but if you just look at this and say, hey, we've had a long-term downward trend here for the last 40 years. This was a cyclical bull market in bonds. Now you may be thinking, Mark, wait, the chart's going down. This is the rate of the 10-year treasury. That's the yield that it pays. And you look up here, this is during the bear market we had in the early 80s. We remember that had high inflation, just like we have now. We had rising interest rates, and then we saw those begin to fall off over the next 40 years. Now, that really has come to an end of the 40-year bear market, or bull market in bonds. And you kind of see, if I drew a line on there again, you can see over here in 2022, interest rates have spiked, and they will continue to rise, but potentially when the Fed continues to raise interest rates as well. But notice these little shaded areas on here. These little shaded areas on our chart, we had one in the late 60s, early 70s, late 70s, early 80s, and then we had over here, the last one that we have on here is the great financial crisis in 08 and 09. And then we had a little teeny tiny one in 2020 at the start of the pandemic. That only lasted a month. But what you'll note is that we'll see in just a minute that those recessions are typically normal. The government says we are not in a recession right now, but all the data says yes. So looking at this 10-year treasury a little bit more, right now on 12/31 of this year, the 10-year treasury rate was down here at 1.5%. Okay. As of yesterday, that 10-year treasury rate was 3.2%, 3.21. It has more than doubled in the last 8 months. The yield, or the interest on a 10-year treasury, has more than doubled. Now, you think that's great. Well, it means higher borrowing costs. Mortgages have gone from less than 3% to over 6% in some cases. So this is very instrumental. This is going to start cooling the economy off when people can no longer afford houses. Let's look at a little more stuff here. Now, this is the consumer price index going back to 1965. This is what we refer to as the inflation rate, okay? And you see these spikes back here in 1980. But what I want to show you, want to point out to you, if you notice I have to look at my key here because I don't want to tell you the wrong one. The blue line is the consumer price index, or inflation rate, for all items. We include food and energy in here, okay? And you'll notice that when there's a spike in that rate, or inflation rate, it's usually in the middle of a recession or at the beginning of a recession. Now, we had two here in the early 80s, mid 80s. We had another little spike here in 1991. That was around the time that President Bush was raised taxes. It created a little recession. And then, of course, we remember back here in 2008 and 9, we had inflation spike up, and we were in a recession. We don't have a recession label on here because technically the government has not told us that, but you can kind of suspect here, spike in inflation where we are now usually is followed sometimes with a recessionary period, meaning that we're having negative economic growth. And usually what we're seeing there is that economic growth will slow down in terms of declining GDP, but also declining employment. And we're going to get to that in just a minute, because I think that's important to note that this time is a little bit different with that. Let's take about a little fact here, a couple of factoids here. I heard this, I was listening to a podcast this week, and I went and found the data from this. This is going back, this is University of New York at, it's the Stern Foundation there at one of the New York University colleges. But this is a bar chart here, and it shows that there were only, in the last 100 years or so, there have been only 8 times where we had the S&P 500 index and the aggregate corporate bond index in the negative on a yearly basis. Let me say that again. There were only 8 times that we saw both the S&P 500 index and the corporate bond index in negative territory at the same time, because folks, we've been trained as consumers to think, well, if the stock market's going down, then bonds should be going up because everyone's fleeing to there for safety. This time is different because we're also rising interest rates at the same time. I'll put up my little analogy. You've seen this before if you've talked with me before, but when on one side of a bond is like a seesaw reaction here, on one side of the bond is the price of the bond, on the other side is the coupon or the interest rate or yield of that bond. What we've had the last 40 years is falling yields, falling interest rates. That's over. We're starting to see rising interest rates. And so that's why, partly why you're seeing such a dramatic impact on your portfolio. Remember I said that 20-year long-term treasury index was down over 24%. That's in part. Now, so 8 times in the last 100 years have we seen both the S&P and the corporate bond index down more, or both negative at the same time. But there have only been 2 times that we've seen the S&P 500 and the corporate bond index below or down more than double digits. Okay. And those were in this year, 2022, and the last one was 1931. And I don't think there's anybody on the call that doesn't remember what was going on in our country in 1931. We were in the middle of the Great Depression. Now, that's not to try to be a doomsday sayer and things are going to be bad, but it's really interesting to note that this has only happened twice in the last 100 years. The last time it happened before this year was in 1931. And you can see on the chart, the S&P went down that year minus 43%. So, interesting times we're in. 2022 is not over, but it does tell a story about the current conditions of the markets. We don't see that very often. Let's talk about employment. Now, yesterday, the August jobs report came out. The consensus expectation was for us to add 290,000 jobs. That actual numbers actually beat expectation, which normally we'd say that's great, right? The economy's strong. We got people that are getting jobs. Now the unemployment rate rose to 3.7%, and that's because more people were now going back to work. And I don't know if this is a combination of people's COVID benefits are running out, and so therefore they're seeking work, or if it's the end of the summer and you have a lot of students that were taking the summer off now looking for jobs. I don't know, but the labor force participation rate increased slightly, and that tells us that there's more competition for those jobs, but we still have an enormous amount of job openings. Over 11 million jobs are unfilled right now. Now, why do I share this with you? Because normally a positive jobs report would be good news, except for the Federal Reserve. They really wanted to see employment to be a poor report, right? Few jobs are adding, meaning that the economy is slowing down, because that would give them the indication and the data that they needed to say inflation's over, we can slow down our interest rate hikes. So this is the one time that a strong jobs report is not positive for the stock market. We actually saw yesterday the stock market fall. It ticked up at the beginning of the day quite a bit and ended in the negative. I think about the S&P was down about 1% by the end of the day. And that's as people began to absorb the data, what normally is a positive thing was actually a negative thing in this situation. So one thing we're looking at here is more people are working, but the average number of hours they're working every week actually fell. And that really leads to us that productivity is actually going down. Okay, so let's talk a minute, because I get questions all the time about Treasury inflated protected securities. Now there's several out there, mutual funds and things. We're not talking about the tickers. So the top chart here is really looking at 2021. And you saw both the Treasury inflated protected securities and the aggregate bond index actually were positive for the year. I think the aggregate bond index was just flat or barely negative, but they were doing well. 2022, we're looking at both of those things going down. And normally, Treasury inflation protected securities are going to, you would say, do well if we have rising inflation. And the way that these work are they work is the principal value of the bond is tied to the rate of inflation. And when inflation goes up, the principal value of the bond should go up as well. But investors don't get the inflation adjusted principal value until maturity. So the economy can be all over the place in the meantime, which means inflation, deflation, rising rates, falling rates, and everything in between. So while inflation protection built into these bonds is one of a kind, those inflation protected securities can really be volatile on the way. The problem this year is that those inflation protected securities are acting more like a bond rather than an inflation hedge. And this is one of the problems that we've been dealing with. So those places have not been a place for safety this year. For those of you that were listening to the radio broadcast, you heard we spent the entire show talking about student loan forgiveness and the executive order that President Biden signed into law this last week, or enacted. It's not a law necessarily, it's an executive order, where borrowers can have forgiven up to $10,000 of student loan debt, federal debt. There are income caps, so if you're making more than $125,000, you'll not be eligible. Those of you that receive Pell Grants, then you can have more than almost $20,000 forgiven. The big thing that was in here that not a lot of people are talking about, and we talked about it extensively in the show, was that there are repayment caps for future repayment. And our borrowing system for colleges is broken. I shared on the show how I went through this process myself this summer for our child that's going into college this year, and I was appalled about how bad and how little information was given to the borrower. Basically, it was just given a blank check. And no wonder we have a problem with student loans. But repayment caps for the future, meaning that I don't have to pay more than 5% of my income. And if you make below $30,000, you don't have to pay anything at all. And if I just make regular payments for 20 years, I'm capped at the amount I can pay, I will have all those loans forgiven. So this is not just about wiping out $10,000 of student loans. This is about basically changing the nature and the landscape of college cost. We're going to see college costs just skyrocket, because now what's happened with this executive order is that colleges are going to be given essentially a blank check, because it'll allow students to borrow more money, which is going to happen and needed, because if the cost of education is going to go up. And the estimate from the White House was it's going to cost about $240 billion, but there's no indication of how the government will foot the bill. I've seen some crazy things this week. I actually saw a congresswoman come out and say that taxpayers don't need to worry about paying for the student loan forgiveness because the federal government's going to take care of it. And I guess she either skipped that day in class in civics when they're talking about how the government is funded, but there's a lot of unknowns here. It's actually there's some economists that I've seen that say that they don't know the total cost, but it will be well over $1 trillion over the next 10 years. So that's concerning. It sounds good, but it's going to cause a lot of problems. College costs are going to soar even more, and we're also going to have lots of forgiveness on those loans. And basically, you just have to pay a little bit for college and borrow as much as you want. Eventually, it will be forgiven. I expect to see challenges on this in the courts. So stay tuned. We'll keep you apprised on our show or through our client communications. Okay, so we have a couple of webinars coming up. September 13th. Oops, it's moving on me fast. Didn't mean to do that. September 13th, Managing Healthcare Expenses in Retirement. September just in time, or October just in time for open enrollment. Social Security and Medicare, we'll unlock that. And then financial planning, last chance financial planning in November. Just go to spendlifewell.com if you want to and look at our events here with that. And so anyway, I don't see any questions on the board. So I'm going to give your Saturday back to you and just say thank you for listening. A lot of unknowns still here. If it's been a while and you're a client and we haven't visited in a little while, give our office a call or just go to my Calendly thing and schedule a phone consultation. If you'd like to meet in person, just call our office and we'll arrange that for you. So folks, I want to appreciate your time today and I wish you a blessed Labor Day weekend. And if you have any questions, please give us a call. Thank you for joining us today. Have a great day.